So, hey guys, we're gonna start learning about how do interest rates affect the stock market, guys. The investment community and financial media tend to obsess over interest rates, and for a good reason. Interest rates refer to the cost someone pays for the use of someone else's money. Yay! We learned what interest rate is, guys. Now, when the Federal Open Market Committee, FOMC, which consists of 7 governors of the Federal Reserve Board, wait, we learned about this, guys, right? And 5 Federal Reserve Bank presidents set the target for the federal fund rate, the rate at which banks borrow from and lend to each other overnight. Oh. It has a ripple effect across the entire US economy, including the US stock market. And while it usually takes at least 12 months for a change in the interest rate to have a widespread economic impact, the stock market's response to a change is often more immediate. So in terms of economic impact, it could take at least 12 months. But for the stock market, it goes right away. That's so sad. Besides the federal funds rate, the Federal Reserve also sets a discount rate. The discount rate is the interest rate the Fed charges. The discount rate is the interest rate the Fed charges banks that borrow from it directly. This rate tends to be higher than the target federal funds rate, in part to encourage banks to borrow from other banks at the lower federal fund rate. Dude, this is a very good tongue twister. 이거 왜 이렇게 어려워? So they're saying that the federal rate also there's also a Federal Reserve discount rate, right? And that the discount rate is the interest rate the Fed charges bank that borrow from it directly. So if you're borrowing money directly, there is a discount interest rate because I guess you're getting money directly. And then this rate tends to be higher than the target federal fund rate compared to the when you borrow money from other banks. I think I'm getting this so completely wrong. But yeah, right? Besides the federal fund rate, the Federal Reserve also sets a discount rate. Because when I think about discount, well, I guess there's like a definition of that it's an interest rate the Fed charges bank. Now the key takeaways. When the Federal Open Market Committee changes the interest rate, it impacts both the economy and the stock markets because borrowing becomes either more or less expensive for individuals and businesses. Any impact on the stock market to a change in the interest rate changes is generally experienced immediately, while for the rest of the economy, it may take about a year to see any widespread impact. Widespread, not wild. Sorry. Higher interest rates tend to negatively affect earnings and stock prices, with the exception of the financial sector. Understanding the relationship between interest rates and the stock market can help investors understand how changes may impact their investments. They can also be better prepared to make better financial decisions, which is true. That's also true. So if you guys know the reason why and kind of see the trend of when it might be happening or the news of why it's happening, you could, I guess, figure out when to exit, right? The federal fund rate, the interest rate that impacts the stock market, is the federal fund rate. Funds rate. The federal funds rate is the interest rate that depository institutions such as banks, savings and loans, and credit union charge each other for overnight loans, whereas the discount rate is the interest rate that Federal Reserve Bank charge when they make collateralized loans. What is collateralized? Collateralized loan. That is a very hard, lots of L word. Usually overnight to depository institute. So it seems that the fund rate is when they charge each other for the overnight versus Federal Reserve Bank when they make a... What is this? I'm getting better? Thanks. Collateralized loans. Right? What is this? 부정당하다? Oh, is this, I guess, a hard concept? Just gonna note this is a hard concept. But I guess for this one, we just have to know that the federal fund rate is gonna be different from the discount rate. And the federal fund rate is basically charging the depository institutions overnight loans against each other, for each other. It's just a loan where you use assets, cash, or other assets to borrow things. 담보. This is 담보구나. Isn't that funny? I know it in Korean than English. So the Federal Reserve influences the federal fund rate in order to control inflation. By increasing the federal fund rate, the Federal Reserve is effectively attempting to shrink the supply of money available for making purchases. This, in turn, makes money more expensive to obtain. Conversely, when the Federal Reserve decreases the federal fund rate, it increases the money supply. This encourages spending by making it cheaper to borrow. The central bank of other countries follow similar patterns. Below is a chart that shows fluctuation in the federal funds over the past 20 years. 맞아, 영화 때문에 담보라는 단어가 되게 익숙한 것 같긴 해요. This is so hard to understand. The federal fund rate is significant because the prime interest rate, the interest rate commercial banks charge their most creditworthy customers, is largely based on the federal fund rate. 이게 중요한 거네. This federal fund rate is very important. It also forms the basis for mortgage loan rate. And the credit card annual percentage rate and the host of other consumer and business loan rates. So this kind of is the basis. Oh, it says it here. So what happens when the interest rate raises? So I'm guessing the interest rate here, what are they talking about? Let's read. When the Federal Reserve acts to increase the discount rate, it immediately elevates short-term borrowing costs for financial institutions. This has a ripple effect on virtually all other borrowing costs for companies and consumers in an economy. Because it costs financial institutions more to borrow money, these same financial institutions often increase the rates they charge their customers to borrow money. So individual consumers are impacted through increases to their credit card and mortgage interest rates, especially if these loans carry a variable interest rate. When the interest rate for credit cards and mortgage increases, the amount of money that consumer can spend decrease. You got all that? 장기들의 담보만 안 하면은? 장기를 담보하는 거구나. 와씨. This feels like a tongue twister. Yeah, let's get a simple explanation of all this. Because it costs financial institutions to borrow more money when these same financial institutions often increase their rate they charge their consumer to borrow money. So they're increasing to get more money because it costs financial institutions more to borrow money. Why is everything related to money, guys? So individual consumers are impacted through the increase to their credit card and mortgage increase, especially if these loans carry a variable interest rate. When the interest rate for credit card and mortgage increase, the amount of money that consumers can spend less. So you wanna higher interest rate, but it still would feel like you're spending that much money. No? Because first, initially, I thought, so then because if this increased, then it feels like the consumer's spending less. So then why don't you guys increase the credit card? You know, the interest rate for the credit card. But when you like realize signing up for it, then you're gonna kind of be like, the heck? So lower interest rate means people have to pay less to borrow. Yeah, which means you have more money. There's an article about this in Reddit, really? Which means they will spend more and the business will get better. But here, how come they say when the amount of money that consumer can spend decrease? Because it's high. Oh, that makes sense. Oh, I read that completely wrong. Because I read it as... I totally understood the sentence as if the interest rate for credit card and mortgage increase, then the amount of money that they spend will decrease, but the amount of money that they will be spending will be much lesser. Okay, I got it. It's so confusing. Don't you think this is confusing? I bet there's an easier way people explain this. This is why we need to figure out how well they're saying this for people like me who can't understand this, who look so lost, right? Now, moving on, consumers still have to pay their bills. When those bills become more expensive, households are left with less disposable income. When consumers have less discretionary spending money, businesses' revenues and profit decrease. 그치, that makes sense. So if your interest rate just gets higher, people don't want to spend money. It's kind of like related to inflation too, no? 아닌가? Oh, it's not like that? Because you have to spend so much money on interest rates that you'll just have less money. Yeah. Unless they have second job. Maybe that's why people are doing a lot of second jobs, right? Oh. Say like you're buying a car. You have to borrow 20K. And you gotta figure out how much the interest rate is. But if it's too high, then you can't borrow the full 20K. Oh, that's true. That's true. Okay. So as you can see, as rates rise, businesses are not only impacted by higher borrowing costs, but they are also exposed to the adverse effect of flagging consumer demands. Both of these factors can weigh on earning and stock prices. So what happens when the interest rate falls? When the economy is slowing, isn't this what we want to hear though? When the interest rate falls. 이게 좋은 거 아닌가? The Federal Reserve cut the federal fund rate to stimulate financial activity. A decrease in the interest rate by the Federal Reserve has the opposite effect of a rate hike. Investors and economists alike view lower interest rate as catalysts for growth. Oh, this sounds good, right? Catalysts for growth, a benefit to personal and corporate borrowing. This, in turn, leads to greater profit and a robust economy. So you just wanna see more of interest rate falls, right? Now, consumers will spend more with the lower interest rates, making them feel that perhaps they can they can finally afford to buy that new house or send their kids to a private school. Business will enjoy the ability to finance operations, acquisitions, and expansions at a cheaper rate, therefore increasing their future earnings potential. This in turn leads to higher stock prices. Now, particular winners of lower federal fund rates are dividend-paying sector, such as utilities and real estate investment trusts. Oh, this is another investment thingy. Additionally, large companies with a stable cash flows and strong balance sheet benefit from cheaper debt financing. Ooh. 이거 너무 당연한 거 아니에요? I feel like this is one of the obvious, right? Someone. You know what I mean? I was maybe expecting it, but like when I first read that section, I was kind of expecting it to be the inflation rate, where you don't want to have too high inflation, but also a very low inflation rate. But I guess for interest rate, it doesn't really matter. Now, interest rates and the stock market, I guess it's talking about how it's going to affect each other. If a company is seen as cutting back on its growth or is less profitable, either through higher debt expenses or less revenue, the estimated amount of future cash flows will drop. All else being equal, this will lower the price of the company's stock. Oh, really? So if it increases, if enough companies experience declines in their stock prices, so today isn't caused by interest rate, but just cause of war, right? I was just thinking about this. So if the company experiences declines in all the stock prices, the whole market or the key index many people equate with the market, the Dow Jones Industry Average, S&P 500, etc. will go down. Makes sense. With a lowered expectation in the growth and future cash flows of a company, investors will not get as much growth from the stock price appreciation. This can make the stock ownership less desirable, and then I guess they might sell it. Furthermore, investing in equities can be viewed as too risky when compared to other investments. When they say less desirable, is it like it doesn't worth as much? I guess they end up selling this. So, however, some sectors stand to benefit from interest rate hikes. One sector that tends to benefit the most is the financial industry. So banks, brokerage, mortgage companies, and insurance companies' earnings often increase as interest rates move higher because they can charge more for lending. Now, how does interest rate affect the bond market? The interest rates also impact bond prices and the return on certificate of deposit, treasury bonds, and treasury bills. There is an inverse relationship between bond prices and interest rate. Oh, I like inverse. Does that sound weird? Sorry. As interest rate increases, right, the bond price falls, and vice versa. The longer the maturity of the bond, the more it fluctuates in accordance to changes in the interest rate. When the Federal Reserve rises the federal funds rate, newly offered government securities such as treasury bills and bonds are often viewed as a safest investment. They will usually experience a corresponding increase in interest rates. In other words, the risk-free rate of return goes up, making these investments more desirable. Risk-free rate of return. Ooh. As the risk-free rate goes up, the total return required for investing in stock also increases. Therefore, if the If the required risk premium, sorry, decreases while the potential return remains the same, investors may feel stock have become too risky and will put their money elsewhere. Some of these sections seem very like obvious, and so they explained it using hard word to explain this. 뭔가 되게 당연한 것들, 되게 간단하게 생각하면은 당연한 것들고 쉬운 것들인데 막상 쓰면 정말 텍스트북처럼 너무 어려운 것 같아. I think it's written for like a finance major. Oh, this is why I could never do finance. I was like, that's some big words over there, right? Yeah, that was all big words. Like, it's so obvious. Guys, if there's a risk-free, if you know that there's no risk of a company, obviously you want to make an investment. And then like obviously you would want to invest in it, right? You feel like it's, you know, and then if it goes down, then you're gonna be like, oh yeah, obviously I don't want to do it. So lots of obvious. Oops. Obvious. Now the importance, the measure of the sensitivity of a bond's price to a change in interest rate is called the duration. I guess it'll come next time. You gotta post links if you are subbed to my channel. If you're not subbed, I don't allow post links. Now, one way government and business raise money is through the sale of bonds. As interest rates rise, the cost of borrowing becomes more expensive for them, resulting in higher yielding debt issuance. Simultaneously, market demand for existing low coupon bond will fall. What is low coupon fall? Somehow that reminds me of coupon. Risk-free means things like treasury bills. Oh. Would risk-free would also include like NASDAQ or ETF? Or are those not it? No? So anything related to government like investment, those are risk-free? So not related to anything that's stock market-y. I guess you could even call it like, yeah, I guess, but how, I guess that's when you have to think about if the interest rate is going up. I think it's interesting that they can measure the risk-free of, like, risk-free rate of return. Like, how? I think that would be something interesting to look into, is how do you measure if it's going to be risk-free rate of return? Like, there's so many factors that you have to incorporate. As an engineer, this is a very hard topic. So, for income-oriented investors, a reduction in the federal fund rate means a decreased opportunity to make money. Woo! We can... Oh, wait, it's a decreased opportunity. Sorry, it's sadji. Very sad. So, we don't want the reduction in the federal fund rate. Now, newly issued treasuries and annuities won't pay as much. A decrease in interest rates will prompt investors to move money from the bond market to the equity market. The influx of new capital causes the equity market to rise. I don't know why I suddenly thought it was raise. Oh my god. Sorry guys, I can't speak English. I always say this every time I have to read something. I can't read anymore. It's getting worse, and I feel like I do more reading nowadays, and it's still getting worse. The impact of expectation. We're almost done, guys. Don't worry. Just hang on. Nothing has to actually happen to consumers or companies for the stock market to react to interest rate changes. Raising or falling interest rates can also impact the psychology of investors' psychology. Well, obviously. Okay. When the Federal Reserve announces a hike, both businesses and consumers will cut back on spending. That's true. This will cause the earning to fall and stock prices to drop, and the market may tremble in anticipation. Now, on the other hand, guys, when the Federal Reserve announces a cut, the assumption in consumers and businesses will increase spending and investment. This can cause stock prices to go high or to rise. This is why, guys, I think no wonder it kind of connects the dot. No wonder every time there's a Federal Reserve announcement, you guys work so hard to listen to it because of this. So next Federal Reserve, I will try to watch it and see how it goes. I guess we could do like a Federal Reserve reaction. Hey, we're not just doing reaction for K-pop. Federal Reserve is a very interesting thing to watch and listen and see. Maybe someone might start throwing things at each other. If expectations differ significantly from the Federal Reserve's action, these generalized conventional reactions may not apply. For example, suppose that the Federal Reserve is expected to cut interest rates by 50 basis points at its next meeting, but they instead announce a drop of only 25 basis points. The news may actually cause stocks to decline because the assumption of a cut of 50 basis points has already been priced into the market. Oh, really? There's drama happening if you watch them? That's really cool. So 832, the number of points the Dow dropped on October 10th, 2018 due to the fear of higher interest rate. That said, the Dow also dropped even more significantly in March 2020 as the Fed cut rates to nearly zero amid the global coronavirus pandemic. Wow, you could cut the rate to zero. Wow. The business cycle and the economy is in it can also affect the market's reaction. At the onset of a weakening economy, a modest boost provided by lower interest rate is not enough to offset the loss of economic activity. That's true. Stocks may continue to decline. Conversely, toward the end of the boom cycle, when the Federal Reserve is moving in to raise rate, a nod to improve corporate profits, certain sectors often continue to do well, such as technology stocks, growth stocks, and entertainment and recreational stock companies. Recreational company stock. So the bottom line, guys, all big words, but in the end, although the relationship between interest rates and the stock market is fairly indirect, the two tend to move in opposite direction. As a general rule of thumb, when the Federal Reserve cut interest rate, it causes the stock market to go up. When the Federal Reserve raises interest rate, it causes the stock market to go down. But there is no guarantee as to how the market will react to any given interest rate changey period. So, I guess that's the end of interest rate. It did state the obvious, but it was really good article to see the examples and how it was being affected. So this was very interesting. I also find it interesting that there's multiple ways that they could explain something in a confusing way. So that was also unique. But yeah. But where do you find interest rate? Do you just type in federal fund rate and oh, thank you, and it'll tell you like what it is right now? I hope you guys enjoyed listening to me talk about the interest rate and how it affects the stock market. If you guys have any questions, feel free to ask. Other than that, I'm done. Whee!